So a couple weeks ago, I did a video on one aspect of Trump's tax plan. Today, I want to talk about Vice President Harris' plan, or at least a few aspects of it. After all, her team has released a lot of details about her plan, but a lot of which was not shared at the DNC nor debate. So what I want to do, since there's so much to cover, is break her plan down in three parts. Part one on the part of the plan that affects individuals, part two on the parts that affect businesses, and part three on the parts that overlap both individuals and businesses right after this. Listen, I'm on a mission to make sure you protect your hard-earned money, no matter who wins the presidency. That's why I want you to join me at the Tax Strategy Conference, October 21st through 23rd, from 7 p.m. to 9 p.m., where I'm going to teach you the secrets to living a tax-free life just like the wealthy. If you're tired of overpaying IRS, having too much withholding taxes taken out of your paycheck, or paying capital gains on your real estate sales, you can't afford to miss this event. Register today. You'll be glad you did. I'm Kinite Ledbetter, founder and CEO of This Is Why Inc., a finance and business management firm located in the DMV area. I'm a tax strategist and business formation expert, and what that means in short is that I help my clients make more money, pay less taxes, and stay out of trouble with IRS. So let's jump into part one, plans that affect individuals. First, I want to go over the plans that she consistently shares in her speeches and interviews. Then I want to add a few that seem to be conveniently left out. So what are the plans that she consistently speaks about? Number one, expanding the child tax credit to $6,000. Number two, providing a $25,000 down payment assistance to first-time homeowners. And number three, not taxing tipped income. Let's jump into it. When it comes to expanding the child tax credit from the now $2,000 to $6,000, this sounds good on the surface. However, what's not being said publicly is that this credit will only apply to newborn babies and in the first year of life only. Currently, the way it stands, the child tax credit applies to children 17 years and younger, which means, as it stands, you get to utilize this credit for 17 years of your child's life. And basically, that's $2,000 times 17 years, which is a total of $34,000 over that period of time. What we do know about Harris' proposal is that the $6,000 will only apply to newborns and only in the first year. What we don't know is if after the first year, the current credit of $2,000 kicks in from years 2 through 17. This is very concerning because while newborns can be expensive, kids are expensive, period. At any age, when you start to factor in things like growth spurts, increased appetite, extracurricular activities, and so forth, $6,000 in year one becomes peanuts. Okay, let's talk about the $25,000 payment assistance to first-time home buyers. This is exciting as well. So I hate to be the Debbie Downer and tell you that this is not down payment assistance, because the down payment assistance reduces your out-of-pocket at closing. This is actually a tax credit that will be issued over the course of 4 years, which means the credit breaks down to $6,250 each year for 4 years from the date of your purchase. Yeah, that part is not being said from the platform. Now, you might be saying, okay, that's not so bad. But before you land there, let me give you a few questions to think about. Number one, can this credit be used across any 4 years, or does it have to be used in the first 4 years consecutively after you buy the house? Now, why is this question important? Because let's say in the first 4 years after you buy the house, you don't even have a tax liability. That means you can't even use this credit because tax credits only offset tax liabilities, unless it's a refundable tax credit. And currently, we don't have any information on whether it's refundable or non-refundable, which leads me to the next issue, which is whether or not this credit is refundable or non-refundable. Because as I previously illustrated, if your tax liability is less than the credit or zero, you either only get to use a portion of the credit or none at all. So, Vice President Harris, we need more answers. Can this credit be used across any 4 years, or is it consecutively after I purchased the home in the first 4 years only. Because if it's consecutively, any new homeowner that does not have a tax liability will lose the benefit of this credit, and it really becomes irrelevant. Is it refundable or non-refundable? Inquiring minds want to know. Finally, she talks about exempting income tax for tip workers. I do think this is a great idea, but can I tell you a secret? It's a setup. See, most tip workers don't report their tip income anyway. And I'm not saying it's right, but it's true. And so now what happens is tip workers will start to report their tip income. And in 4 years, or probably less, this law can change. Then they'll have to start paying taxes, and they'll try to stop or return to not reporting their tip income again. But now IRS know you used to report it, and now all of a sudden you're not. Guess what? You're going to get audited. By the way, did you know that there are tax credits and incentives for employers of tip workers to report the tips their employees receive? And with the use of accepting tips via Cash App, Zelle, Venmo, and other electronic methods, there's a paper trail. I'm just saying. All right, let me quickly share with you a few changes in her tax plan that she isn't shouting from the rooftop. Did you know that she plans to increase Medicare tax from the current 2.9% to 5%? See, this will affect everyone, higher or lower earning employees. Did you know that she plans to tax unrealized capital gains? Okay, just in case you don't know what that is, let me give you an example. Let's say you purchased stock for $500 and now it's worth $5,000, but you haven't sold it. It's still in your portfolio. You have what's called an unrealized gain of $4,500. Well, under this part of her tax plan, you would be taxed on the $4,500, even if you haven't physically received it yet. Now, I know what some of you are thinking, well, that's only going to apply to the rich, but let me tell you why this is dangerous and give you a quick history lesson at the same time. Now watch this. When income tax system first started out, it was only going to apply to the quote unquote rich. That's right. In 1913, income tax was only applied to the wealthy. But guess what? Most of you watching this, whether you're wealthy or not, pay income taxes. You know why? Because once you get laws like this passed and society is used to it on a whole, it's so easy to expand it to everyone else. So right now she's saying it's only going to apply to families with 100 million in wealth. But guess what? Next, it'll apply to families with 1 million of wealth, then 100,000 in wealth, then 50,000 in wealth. You get the picture. You know what the point I'm trying to make. And will it stop there? I mean, will the next thing be you'll start getting taxed on things you haven't bought yet? The unrealized car you haven't bought, the unrealized house you haven't bought. And listen, that's not even my biggest issue. Can I tell you what my biggest issue is? My biggest issue that there is nowhere where it mentions what happens if you have a unrealized loss. Because let me say this. Whenever there's a potential for capital gains, there's also the potential for capital loss. And there is no mention of a credit for unrealized losses. Go figure. Just think about that for a minute. Okay, next. Did you know that she planned to tighten the rules on estate tax? Now, her plan is very obscure about what it really means by tightening the rules. But let me give you a brief understanding of how and when this applies. When someone owns a home and passes away, and let's say, for an example, they leave a home as an inheritance, their heir qualifies for what's known as a stepped-up in basis. What this means is that they pay no capital gains tax on the appreciated value of the house if they sell it. So for an example, if you inherit a house that was purchased for $150,000, which would be its basis, but at the time of your inheritance, it's worth $500,000 and you sell it for $500,000, you profit $350,000. And in normal cases, that you will have to pay taxes on $350,000. However, with the stepped up in basis, the home steps up in basis at the time of the inheritance to whatever the current market value is. And in this case, or the case of our example, if the house is now worth $500,000, this means that when you sell it for $500,000, your basis is now zero. So you owe zero in taxes. See, this diminishes the whole idea of passing down generational wealth. And if I may, it almost seems like a penalty for success. Okay, last but certainly not least, did you know that she planned to limit retirement account contributions for high income taxpayers? Now, one of the reasons we strive and work hard and seek to increase our income in our early years is so that we don't have to work so hard in our latter years. So if I earn well, I get limited on my ability to put my own money away. So I can plan to stop trading time for dollars. See, who wants to work forever? And this almost seems like a plan to keep people stuck in the rat race. Listen, I'm not repeating to you guys what I heard on social media. In fact, I wouldn't even listen to any social media videos about Harris or Trump tax plans until I had the opportunity to read them for myself and form my own opinion. And I'll tell you, while these videos are not an endorsement for or against any candidate, in my humble opinion, I don't really see how this tax plan is going to really benefit the middle class. But you have the facts. Now you can decide for yourself. This is just one aspect of Harris' tax plan. For details about both the Harris and Trump tax plans, like and subscribe if you haven't already done so, and share this video with others so they can be equally informed. I'll talk to you soon.